Quick overview of what we're going to go through to see how your business financial statements connect. We're going to do 12 transactions and they're listed here. We're going to start your business with $1,000 of your own cash from outside of the business. We're going to buy 100 widgets. We're going to sell 100 widgets. We're going to buy 200 more widgets. We're going to get a loan. We're going to sell some more widgets. We're going to rego our car, our vehicle we just bought, insure it, and then put some petrol in it. We're going to see what happens when you get a bad debt. We're going to see when you pay your employees. You're going to sell some more widgets and have a look at what happens with your cash flow. You're going to get paid. You're going to pay some of your suppliers. You're going to do some car repayments, including interest and what that does to the value of things. And then at the back end, we're going to have a look at what happens when you depreciate your vehicle from a tax perspective and how it all hangs together. So let's rip into transaction one. G'day everyone. So now we're going to hook it all together. Let's see how all these financial statements hang together with a test business. Our balance sheet is like a snapshot in time. It shows us at any one instant what our business owns, the things and stuff that it owns. It shows what we owe to other people, the money we owe. You can't owe things and stuff to other people, but it talks about the money we owe. And then the difference between those is the equity, or what the business owes us. So this is a snapshot. The balance sheet is the most important part of the financial statements, and it's the thing that holds everything together, as you're going to see as we go through this. So let's imagine we're going to start a business, and we're going to start with $1,000 from our own bank account. And we're going to set up our financials, whether we've got Xero or QuickBooks organized. This is how it all starts to happen. Okay, so we're going to take $1,000 cash, and we're going to add it into the cash section of our balance sheet. Now, I want you to really understand something about the balance sheet, and that is to do with this equation here that you've seen in the other videos. Total assets equals total liabilities plus equity. Or if you rearrange the equation, if you've seen in some of the other videos, it's equity equals total assets minus total liabilities. And that is key in business and the accounting system. That's why we have double entry accounting, and the balance sheet is the most important of all your financial statements. It must balance. This is the rule of accounting. It's like a gravity rule. If you mess with this, your numbers don't make any sense. And you're going to see as we go through this why the balance sheet is so important in that way, why it's set up this way for a series of balance and checks as we go along. It's to make sure we don't mess our numbers up. It's actually very clever. If you get it right, it will balance. Now you can see over here, I've got a big cross and a sad face because at the moment, it doesn't balance. The total assets don't equal total liabilities plus total equity. And your accounting system will flag errors like this when you do it. So we've taken our $1,000 cash from our bank account and we set it up into our balance sheet. But at the moment, it's out of balance. So we need to add this particular entry of $1,000 to starting capital. And you'll see we're all happy now. So let's just break it down what these means. Assets in your business is things that is owned by the business. And I want you to make this really important distinction. You are not your business. The whole point of the accounting statements and setting up structures in that is that you are not your business. As your business grows, you're going to start to realize this. Assets we have at the moment, our things, is cash. And as we go through this example, you're going to see other bits and pieces of how this works. So you can see we have total assets here of 1,000, and we have a starting capital of 1,000 and total liabilities plus total equity of 1,000. So we don't have any liabilities at the moment. You'll see that as we go through. Now, you'll notice that your profit and loss has nothing on it. Your profit and loss is like your report card for how you play the game of business. Now, at this point, we've just kind of entered into the competition. We've paid our entry fee with some money to start our business with, but we haven't actually ran onto the field. We haven't generated any income or got any sales or paid any bills or anything like that. That will come when we get through the rest of this, as you'll see. Hopefully, if you've watched all the other videos, you'll see what I'm talking about in that context. And I've hidden it to start with over to the side here, is the cash statement, which is the one that most people are completely unaware of, yet it's the one thing they're probably most interested in because it tells you where your cash is. So what we need to do with this statement now, and what would have happened is that everything goes through the balance sheet and it gets automatically connected to these other points. And this is where double entry accounting comes from, okay? It has to go in two places. It always goes on the assets or on this side over here, the liabilities or the owner's equity, to check, to make sure it's always balanced so that we don't get any mismatches. Now, how that would play out on your cash statement, and if you've watched the videos, it's basically what actual cash comes into the business, what cash goes out of the business. So in this instance, and what your starting balance was. So we didn't have a starting balance to begin with. So let's say in this instance, we've had $1,000 come into the business. So that is all our cash statement will look like. Now, the interesting part here is the connection here between your cash statement and this part of the balance sheet is that's where this number reflects. Your ending cash is what's in your cash box. So picture you've got a cash box, like a piggy bank or a money box. It's a thing. It's owned by the business, not you. You as an owner have equity in the business, which is what the business owes the owners. And then we need to take away from the assets what the money is owed by the business to other businesses. As we go through, this is going to become clearer and clearer. So let's move on to our second transaction. Transaction 2. So what has happened here, everything has been transferred across. And this is what happens with your books. Xero and Moab and all that do all that sort of stuff automatically in the background. So transaction 2, we go out and we buy 100 widgets at $5 each and we pay cash. So what does that look like? So if we've got 100 at $5, that means that we've just spent $500. And where has that $500 gone to? To the widgets. And we're going to call that inventory. So we're going to take $500 from our cash, because we did buy the widgets, and we're going to add $500 to our inventory. And you'll notice that our little happy face came up here again. So we've basically just taken that cash, and some of it's still in the cash box and some of it sits in inventory, that the business's things that it owns. So this side hasn't challenged and we're in balance. So what does that mean now for our cash summary statement? And you'll notice nothing's happened over here yet. We still technically haven't got on the sporting field to play business. Over here, we've now had $500 cash go out. So the change in our cash, we've gone backwards by 500. We had $1,000 to start with, minus 500, which means we now have $500. And again, you'll see how this connects to our cash box. So that's our second transaction. We've bought our widgets in cash, and now we've been able to load up our inventory and we're ready to get onto the field. So we're going to do that now with our next step. Okay, so our third transaction for our business simulator is we get out on the road, we knock on some doors, and we sell 100 widgets at $10 each, and we get paid cash. How does that now work within our flowing of our business and what's going on? So we're on the playing field. We've got sales. We've actually got $1,000 worth of sales. So we're going to put $1,000 into our profit and loss statement. Now, our profit and loss or income statement is a little bit like a report card. So at the end of the school term, when all of our marks have been added and tallied and so forth, it's the end result that we get. It's a bit like a score sheet in a sport. It records it at the end of the game. There's not much you can do with it other than learn from it. It tells you whether you had a good game or a bad game. It's basically a representation of how well you've run your business. So if you've been able to take the revenue you've generated, minimize your expenses and create a good profit, then that's a pretty good sign. If you've made a loss, then you haven't done a real good job running your business. But just remember, as you've probably seen in some of the other videos, profit isn't cash. Your profit statement, your profit and loss income statement is just theory because it's generated on invoices. It has nothing to do with the flow of cash. But it is a representation, if everybody pays their bills and you pay your bills, of how well do you manage your resources for your business to turn it into profit that we can then turn into cash. Now, our cost of sales was $500 because it cost us for the 100 widgets that we've sold, sorry, yeah, $500. So our cost of sales is $500. Our gross profit, which is equal to our income minus our cost of sales equals gross profit, is 1,000 minus 500 is 500, or 50%. So at this point, the net profit of our business for our trading period, EBITDA, earnings before interest, tax, depreciation, and amortization, is $500. Now, let's have a look at our balance sheet. What happens now? Because our inventory is now gone. We've just sold it all, okay? So we're going to put in $0 of inventory because that $500 went across into our cost of sales. But we had $1,000 worth of cash come in. And you'll notice our balance sheet is not balanced at the moment. But we now have if we look in our cash box, we've got our $500 that was already there. And now we're going to add our $1,000 that just came in with our sales. So we have $1,500 in our total sales. Now, here's the bit where we connect our profit and loss statement to our balance sheet. You see our earnings to date, and that's what we call it. Our earnings to date is going to come from your profit and loss. And this is how your profit and loss connects to your balance sheet. So when we type in our earnings, there you will see that we are in balance. So our accounting system is accurate. And what will automatically happen with your cash summary now is we know that we had $500 cash starting with yesterday, and our ending cash was $500 when we did our last transaction. Now, we've had $1,000 come in. We didn't have any cash go out in this last transaction. So our change in cash is plus 1,000. Our starting cash was 500. Our ending cash is now $1,500. And guess what? We've got our smiley face. And we can see that, again, our cash here equals our cash here. And that's how it connects. So hopefully this is making sense for you. We're going to now move on to our next transaction and how our financial statements actually connect together. So transaction 4, I'm going to give you a pause moment here to think about how you think this would play out. But what transaction 4 is going to be is we're going to buy 200 widgets at $5 each on account from someone. So we're going to get credit from our widget supplier, and we're going to employ someone. So we've got an admin person and we're going to bring them along. So have a pause, hit the pause button now, and have a think about how you think this might look on the different parts of the financial statements. Okay, so how did you go? We're going to buy 200 widgets at $5 on account, and we're going to give someone a job. So let's deal with the first part here. 200 widgets at $5 on account, 200 times 5 is $1,000. But we're not going to give cash over for it. So we're not going to go to our cash box, but we're going to now have $1,000 worth of inventory. And you're going to see we're not happy up here. So how do we balance it? What do we need to do? We're going to add a liability, and this is called accounts payable, what the business owes somebody else. So in this instance, we're going to owe this other business $1,000. So our total liabilities are $1,000, and you'll see we're back to our happy smiley face. Assets, total assets is now equal to our total liabilities plus our total equity, which is our gravity rule here. So we're balanced. Everything's checked and in the right proportions. Profit and loss statement hasn't changed. We haven't played a game. We haven't made a play on our playing field yet. So there's nothing to report. Similarly, cash. Nothing came out of our cash box. So we don't need to do anything here. And this is where it gets a bit confusing for business owners is our equity is what the business owes us as the owners, yeah? But in this instance here, you can see these guys now have a claim on our assets for this inventory. So just because we have the $1,000 here doesn't mean we are now, a business worth $2,500. These guys can claim that back if we don't pay the bill. So, you got trading terms of 30 days and the rest of it. And we'll go through that when we pay that bill as we progress to our next transaction. So let's have a look at transaction 5. All right, so we're up to transaction 5. Business is going great. We're having to do a lot of running around and so forth. So we've decided we need a vehicle, and we're going to get a loan for a vehicle because we've only got $1,500 in cash and $1,000 in inventory. And we're going to need a bit more money than that to get a vehicle. So we're going to get a loan. Here's how a loan will play out in the financial statements. First of all, we've got approval from the bank. Woohoo, great. Non-current liabilities is where we're going to put the loan. Some countries call it a note, but we're going to call it here a vehicle loan. Loan. All right, now that should not be in italics. And you'll notice there's been a few things added here. Non-current liabilities is what a vehicle loan means. Now, the term current means that you will generally be able to pay it within 12 months. Non-current means anything longer than 12 months. Now, for a vehicle loan, and we're taking a vehicle loan of, and as soon as we do this, you're going to see what happens, $10,000. Our little balance man gets all out of balance and all upset here because guess what? Now we can see we've got a whole bunch of load on here with our loan, but not on this side. As you go down the list here in liabilities, it gets what they call less liquid. So the stuff at the top is easy to turn into cash. Of course, on this side, it is cash. It's the same on this side. As we go down, it gets harder to turn into cash. So we've just got $10,000 from the bank. 10,000 plus the 1,500 we already had in there is $11,500. Guess what? We're back to balance. So everything is checked and balanced. Our total assets, looking at our equation here, is equal to our total liabilities and total equity. So we're in good shape. Now, so we go out and we find the vehicle that we're looking for and we purchase it. So now what happens is we now have this asset that is $10,000 value, which is what we paid for it, but we're out of balance. So where does we need to change things around here? Correct. We're going to take the $10,000 that we had in our cash box, the bank gave us to us. We took it out of our cash box and gave it to the dealer. So now we're back to $1,500 cash here, and we're all back to balance on our balance sheet. What does that have to do with the profit and loss statement? Nothing. It's got nothing to do with playing the game of business. We didn't buy or sell anything out on the business field, so we don't do anything here. Remember, this is our report card for how good our business is going. But cash moved. So we're going to see stuff on the cash statement. And the way it looks over here is we had cash come in of $10,000 from the bank. Excellent. Went into our cash box. And then what happened? It went back out again. So you can see at the moment here, our ending cash at that point is $11,500, which is different to our cash, but these are slightly time different. So we had $10,000 go back out again. And guess what? Now we can see the ending cash here is equal to our cash box summary. We now have our new car. We're going to talk about depreciation and how we write off assets and those sorts of things in one of the upcoming videos. So how did you go? You're on track. Okay, so I have to admit, I've made a bit of a boo-boo up until now. So we're up to transaction 6. Did you spot it as we were going along? It had to do with our cash statement. I hadn't been updating it as I was going along. I forgot. So let's go back and I'll show you what it should have looked like. We go back to our first transaction. We had our own money. We put our $1,000 in. Nothing went out. So our change in cash was 1,000. And our ending cash was 1,000, which lined up with our cash box, of course. A second transaction was buying the widgets. So we still had our $1,000 of cash that came in, but 500 went out. So our change was 500 and our ending cash was 500. Now I needed to keep adding the cash as we were going along. We sold 1,000 widgets. So that was, 100 widgets at $10. So 1,000 came in. So we needed to add $1,000 to our cash statement. So now at 2,000, no cash went out. Changing cash, 1,500. Our ending cash is now 1,500. Transaction 4, we buy 200 widgets on $5 at account. So the cash box didn't get touched then. It was all on account. So it's sitting over here on the balance sheet. Now transaction 5 was where we got our loan. So we had 10,000 come in. So our cash was at 2,000. We add 10,000 in for the money from the bank, and our cash out up to that point had been 500, but that $10,000 went back out again. So our total change in cash over the whole time frame is still $1,500, which is where we're up to. We're now up to transaction 6. So hopefully you've kept up with that and it makes sense. And let's start to go through it now. So transaction 6, This time we're going to sell 100 widgets at $10 each, but on account. So we're not going to get paid for it. We're going to give our clients some credit. We're going to register our vehicle for $300. We're going to insure it for $100, and we're going to put $50 petrol into the vehicle. So how does this all look? This is generated by invoices on our system, and this is where it gets confusing. These are all going to be on account, so there will be no change in cash, all right? And this is what a balance sheet is primarily here for. If we're doing cash accounting, you don't really need your balance sheet. It's all just cash transactions. What the balance sheet does is take into account time. So let's have a look. 100 widgets at $10 each means we've increased our sales by 1,000. So now we have $2,000 worth of sales. And you'll notice straight away our little man is unhappy here. He can see that things are out of balance. Can you see where they are? Yep, there it is. It's down in this section here. But let's keep going. You'll see what happens. We've got to add $500 to our cost of sales. Yeah, so that now becomes $1,000. And of course, what that means is our inventory has to go down by $500 because that's where that part connects to the P&L statement. Now we've got a gross profit of $1,000. All right. Now, what we're going to do next is start to add in our rego insurance and our fuel. Okay. So the other thing I will quickly just add in though on the balance sheet is we've got accounts receivable. The reason this is out of balance is we need to add in that $1,000 of credit we just gave. And what you'll see, this comes back into balance. So we're happy now. So our accounts receivable, people who owe us money, our things now, they've got our things. They've got our money in their bank account. It's ours. Based on the invoices and the orders, we've got legally proof that we're owed this money. Now, let's continue over here with what happens to the rest of the P&L. So we said rego of 300. Registration, depending on which country you're in, you'll see little man's gone unhappy again. We said insurance, we're going to put on account as well for 100, and we've got fuel we're going to put on account for 100. So our total OPEX so far for the business, these are the costs of running our business, is $450. Now, guess what? You'll notice that we're out of whack over here again. Yeah, we're out of whack. So what we need to do is add in the vehicle expenses here. Okay, now these are current liabilities. So we're going to put in here fuel, rego, and insurance of $450. And you'll see we've come back into balance again. No cash has changed. The profit and loss statement, whilst it looks good, we made $550 profit, we haven't actually been paid the cash for that yet. So we've still got $1,000, and this is where people get tripped up. Now, as we progress, we're going to start to swing it back the other way. When we start paying our accounts, what happens to our cash box as money goes out of here in our cash statement? So that'll be starting to look at that in transaction 7 and beyond from there. Transaction 7. Inevitably, this is a poor part of what happens in business. We get bad debts. So in this instance, when we got all those sales before, one of those people wasn't completely honest. When they agreed to take our widgets, they gave us an order, we gave them an invoice, and they went broke. We read about them in the paper the next day. Fortunately, it wasn't that bad. $200 is not good, but it didn't actually bust us. So where does this lie in our financial statements? Cash is not affected here. There's nothing going in or out of our cash box. However, a bad debt is considered an operating expense for business, okay? It's a cost we get whether we get a sale or not. So it's a loss when they talk about writing business off. So if we put our bad debt in here of $200, you'll see our little person up here is going unhappy. And how do we balance this on the balance sheet now? It comes out of our accounts receivable. So we need to take $200 off this because we're not going to get that money. So now we go down to $800, and you can see that we're back to happy and balanced again. Sad fact, but we do get bad debts in business. Okay, transaction 7. It's time to pay our employee. They've been very helpful and let us get on and do what we needed to do. And when they started, we agreed to pay them $500. So it's time to cash up. So how does that look on our balance sheet? Let's have a look and go through it now. So first of all, we've got to take some cash out for them. So $1,000 is going to come, sorry, $500 comes out of our cash box. So now our box only has $1,000 worth of cash in it. And you'll see immediately a little person's not happy. Our wages, we put in $500 on our P&L. You'll see we go back to being happy again. But guess what? So far, the business is running at a loss for the month. So that's an indication of how well we've controlled our expenditure and our sales. And at the moment, not a very good job, but we're not there yet. So we'll continue on. How does this affect the cash situation then? So here we have $500 worth of cash is going to go out, because you can see at the moment they're different. So now our cash out is going to be 11,000, which means the change in cash total has been now $1,000. Our ending cash is $1,000, which lines up with our banks, our cash box here. So we're all back to square, but not so good. And this is the challenge with running a business. So day to day, time to time, it varies up and down. And why your P&L sometimes in and of itself, standing alone, is not a good idea. One of the things I'll be doing with my clients is we look at the history. We also have a go at what our projections need to be as well, so that we know whether we're going to run out of money or not, which is pretty much important. Okay, time to move on to transaction 8. Transaction 9. As a business owner, we've had a little bit of heart failure. We've seen a negative number in our profit. Now, that's not good. It means we're not running our business properly, but it's not the end of the world. But however, we decide we need to get out there and do some selling, sell. So we've only got $500 worth of stock. So we're going to sell more widgets. And at the moment, we are going to sell a total of the rest of our widgets, okay? So we're going to sell $1,000 worth of widgets with our $500 worth of stock. So now we've got our sale, great. We've invoiced them, delivered, and all the rest of it. So that means we need to add $1,000 because we sold the rest of what we had, and we're selling it at a 50% margin. So this goes to $3,000 on our income. Now, of course, we've got to take up our cost of sales to $1,500, which makes our GP now 50%. It hasn't changed. You can see we're out of balance here. We need to take our inventory away because we don't have any inventory. We've just sold it all. And we've got an extra $1,000 worth of accounts receivable that we need to add to this. So now we are at $1,800 with our accounts receivable. So you can see we're happily back in balance. And our profit is showing 350, but there's a few things we've got to be careful of. There's no cash has changed hands yet, so that's fine. It's still doing account stuff. That's why we have a balance sheet. We now our accounting equation is sound, but we've got nothing less to sell. So we're going to have to. We've got $1,000 worth of cash. We've got these bills that are building up, and we've got suppliers who probably want their money, and lots of things happening, which is why you've got to know all your numbers in your business. So we're going to move on to our next transaction now and see how you go. Transaction 10. This one and 2 other ones to go in our little exercise. So today we got paid $1,500. Woohoo! We've been sweating on this money coming in. We're getting a bit low. How does it look when it hits our bank account? So first of all, it goes into our cash box or our money box or our bank account, whatever it is, where the dollars are. So 1,500 plus 1,000 means we are now up to 2,500. Obviously, we go out of balance here. Now, as we come down here, it means if we had $1,500 come in, then our accounts receivable goes down by that amount. So we are now down 1,800 minus 1,500 means $300. And guess what? We're back in balance. Nothing shifted on the profit and loss statement. All of the promises in that were made, and your profit and loss is sometimes like it's theory, right? It's not cash moving around. That's what our cash statement summary is. And this is where people get confused. So we've had an additional $1,500 come in. So our cash statement is going to have 12 grand plus 1,500, 13,500 added to it. And you'll notice that these aren't the same yet, but as soon as we do, 2,500 here, 2,500 here, equal here on the bottom, the totals are equal. And of course, our earnings to date so far is $350. So 2 more transactions to go. If you've got questions, post them up, of course. Hopefully this is helping you see how it all hangs together. So transaction 11, we've got a bit of cash in yesterday. So now it's time to pay some of our debts. We're going to pay $1,000 to our suppliers, and we've got a car repayment of $600, of which $100 is going to be interest. So how does this sort of play out? Let's pay our suppliers first. So we're going to take $1,000 out of our cash box. So that's going to go back to $1,500, and we go out of balance. But now we take our suppliers back to zero. We're back in balance. Woohoo! Now we're going to take another $600 out of our cash. So we're going to go back to $900 here. We're out of balance. And our loan vehicle, our loan now goes back $500. We're still out of balance. Now the interest is a cost of doing business. So it goes as a OPEX, an operating expense. And you'll see we come back into balance, except for our cash balance is different. Now we've just paid out $1,600. So we've had $1,600 go out. So that means this number needs to be $12,600 in cash out. Now we're 900 here, and my cash box is back to $900. So we're all squared up. Our profit didn't change. It changed a little bit because of the interest that we had to pay, but we're still looking okay. So one more transaction to go. We're going to look at depreciation and tax and all the rest of it. So let's get ready to look at that. Transaction 12, our last transaction. And today it's the end of the financial year. We're going to depreciate our vehicle. We're going to write off some value in it, and then you'll see how the tax stuff works. And your accountant's the one you got to talk to about tax, not my thing. But let's have a look. So the government decides how much you can depreciate the vehicle by. Now there's a couple of things here. You can sort of write a vehicle off, I'm not sure if it's legal or not, right into your expenses here, but obviously that's going to make your books look really, really bad because you're going to have a massive depreciation cost in here. So in this instance, we're going to depreciate the vehicle by just $200. So the vehicle will now be valued at book value, whatever you want to call it. The government sees it as value. We're going to take $200 off here, and we'll go to $9,800, and you'll see we're out of balance, but we're going to put depreciation over here of $200. Guess what? We're back in balance. So now we've got EBITDA, but we're going to take out the D and the A because now we've included. So this is now earnings, net profit, or earnings before interest and tax. Now the interest is based on if we had other investments in the business where we had interest coming up here in the income, but we don't have that. So in this instance, your accountant would be looking at this value here for what you pay tax on. It's a 2% profit, which, don't know if it's any good or not, depends on the industry, but this has just been a fictional example. However, you could have expensed it all here, but like I said, it would throw your numbers out, whereas we put it over here into our assets and we will write its value down over time to keep our tax. We spread the value of it out, or the cost of it out, if you like. No change in the cash statement. So hopefully this has been really helpful in seeing how all of this starts to hang together, so that when you look at your financial statements, and that's the next challenge. Okay, so now you know what they all mean. How do we use it? And this comes down to a lot of what I do with my clients is projecting forwards, what's going to happen, but also looking at the trends in the past to see where things have slipped or changed by doing lots of comparisons over time. So that ends our mini business example, our My Biz example, and I hope you've got plenty of learning out of it. Bye for now.